Good morning, everyone. Welcome back to the Ever Forward Mindset Podcast. I'm your host and its founder, Michael Rebelo. I'm a 20-year-old entrepreneur that chose entrepreneurship over the traditional college path, inspired and driven by the goal to retire my mother and help other Main Street middle Americans just like her learn about and invest in different asset classes to build long-lasting financial freedom, time freedom, and also to get their liberty back. Last year at the New Orleans Investment Conference, I got the inkling that I'm like, you know what? I'm in real estate and I'm investing in real estate, but I should probably start looking more into gold and silver and also different areas to invest, for example, oil. And I had the pleasure of meeting Adrian Day at the New Orleans Investment Conference last year, and he is with Adrian Day Asset Management. It's a pleasure to have you on the show,
Thank
my
you
friend.
so much for having me. I appreciate it.
Coming all the way from the United Kingdom, I'm sure it was a very long flight.
Yeah, well, I actually live in Puerto Rico now.
Okay, beautiful.
Yeah,
Okay, so it's not
yeah.
so bad.
No.
Good. So I would love to hear your story on how you built your asset management company and what it specializes in.
Yeah, that's interesting. Well, I think it's interesting. You know, I don't have a, I don't have a background in. I didn't follow the traditional route, as most people in this hall didn't follow the traditional route to wherever they wind up. You know, I didn't have an MBA. I think MBAs are not necessarily the best foundation for managing money, frankly. I didn't have a traineeship with Goldman Sachs or UBS or anything like that. I actually was a writer. I wrote on a lot of different topics, and then I settled with personal finance. I don't know if you remember personal finance. In those days, it was called Inflation Survival Letter. Dr. Skousen was actually the editor when I joined. Bob Kephart, who was a great freedom fighter back in the day, long since deceased, unfortunately, and he was the president. Anyway, I was writing on investments. And people would keep asking me, can you manage my money? Can you manage my money? And there was a really interesting thing I noticed that, I'm not saying all my recommendations were good, of course they weren't, and in those days some of them were pretty awful, to be honest. But what did frustrate me was that two people could read exactly the same article, and one would have a success and one would have a failure. And the failure was because the person didn't follow the advice. You know, this is a stock, buy it, use a $2 limit, and they bought it at $2.30 or $2.40, thinking, what's the difference?
Right.
And then when you told them to sell, they didn't sell because they were traveling or because they had a loss or because I had one guy say to me, well, you seemed as though you liked it so much, I didn't want to sell it, but I told you to sell it. So anyway, as a result of all of that, I thought, maybe I should be managing money, and I just set up my own firm. That's the way it started.
Interesting. You know, I like the fact that you said that too, because you could have two of the same things, and someone could be really successful and someone could fail. And you saw that and you went, well, what could I do about that? And I'd like to dive into that aspect of what's happening currently with investing right now. And I'll give you an example. What is currently happening in the United States that gold investors and silver investors should look for? For example, I've invested in silver. I haven't gotten to gold yet. I'm still a fairly novice investor. So what should we be looking for? At least a newer investor should be looking into investing in commodities like gold and silver, just to start.
Wow, that's a 4-hour answer. You know, people who follow gold and silver know that we've had a big run-up over the last 3 years, gold for the last 3 years, silver for the last, year really, and then we've had a big correction this year. First thing I always tell people is, and we were warning them of this all the way up, is mid-cycle corrections in any bull market, frankly, but mid-cycle corrections are not just not unusual, but they're typical. You should expect one. In gold, for example, in the 1970s, we had gold fall 45%, and the gold stocks fell, 75, 80% in the middle of what was the greatest bull market we've had so far. And if you panicked at that low, you missed out on, the main upside. So I always tell people, expect a correction. If you didn't trim earlier, it's too late to trim now. And the things to look for, I always look at why did gold go up and why has it corrected? And I think most people know why gold went up. It's the central banks buying because they want to diversify away from the dollar. They were very concentrated in the dollar, which is an asset of a fiscally profligate government which is willing to weaponize its dominance. That story has been true for 25 years, but it's gathered pace, over the last 10 years, and particularly after the confiscation of Russian assets after the invasion of Ukraine. And so central banks started to say, wow, if I hold a dollar, they can just become worthless overnight if I upset Uncle Sam. I mention all of that because I think it's important that people realize that that narrative did not start with the current incumbent of the White House, and it will not end when the current incumbent departs the White House. So that's a long-standing trend of central banks wanting to move away from dominance in the dollar. That's why it was going up. Now, why did it correct? The war in Iran, or the conflict in Iran, because we haven't actually declared war yet, but the conflict in Iran is what really caused gold to fall, and that seems counterintuitive to a lot of people. They think,
right.
Oh, if there's a war, gold should be up. Not necessarily so. In fact, if you go back all the way back to the Iran oil embargo, you look at military conflicts overseas, gold normally moves up in advance, and then it falls afterwards. It's a little bit of buy the rumor, sell the news, but there's also something else, two other things that are very, very important. In a military conflict, wherever it is in the world, you always have some need for liquidity, and we saw that very much in the Iran conflict when the Gulf states, needed liquidity immediately, and then Turkey, their lira started collapsing, so they needed liquidity. And so the ultimate source of liquidity is gold. People sell gold when they need liquidity. And so we saw it when Russia invaded Ukraine, we saw gold move up in advance and then fall afterwards, and we saw it this time. The second thing that happens that people sometimes forget is that we think of gold as a safe haven asset. Dollar is also a safe haven asset. And when the war broke out, the dollar reversed its downward trajectory and moved up. So we had the dollar moving up, we had yields backing up, and the bonds down and yields up. And then, of course, the CPI moved up because of the spike in the oil price, which leads people to think that the Fed and other central banks are going to raise rates. So all of those things, higher dollar, higher yields, and probably or possibly higher yields in the future, that's all negative for gold. So when will that change? And, if you look at the causes, you sort of answer the question. It'll answer when the war definitely ends, when the oil price comes back a little bit, when the dollar loses that safe haven status, and that comes down a bit, and when the focus of the Fed and other central bankers moves away from inflation. What they call inflation is not inflation, it's higher CPI. That's a different topic. But when it moves away from CPI moving up and moves to the underlying weakness in the economy, and people realize that you really cannot raise rates very much in the U.S.
Interesting. And I kind of want to dive in for a second with the actual gold market right now. So let's rewind all the way back to, I believe, 1972 when Nixon took the gold standard off the dollar. Mm-hmm. And right now, I think it was at the end of last year, gold saw a massive spike. And people have been trying to analyze that. What happened with the gold market? Because now it's the talk of the town. People have started to talk about gold. You should invest in gold. But when gold hit that spike in the beginning of this year and also the end of last year, what caused that? What pinnacle event, at least in the economy or maybe even the news, that caused that to happen?
No, there was no one event. It was really just an acceleration of that trend I've talked about, where central banks in particular have realized that they need an asset that is no one else's liability. If the U.S. government can confiscate dollars because they don't like your policy, mm-hmm. And I'm not, well, anyway, we won't get into Russia and Ukraine, but
right.
but the plain fact is people said, oh, they can confiscate the dollar, and the ECB, European Central Bank, also confiscated the euros that Russia had. Wow, I need an asset that is no one else's liability, that no one else's control. No one else controls, and that is the dollar. And I think what happens with a lot of these trends, you probably know that overused saying from Hemingway, Ernest Hemingway, how do you go bankrupt? Slowly at first and suddenly.
Yes.
And I think that's what you see with a lot of these trends. This trend has been going on for 25 years now. In 1999, central banks held 78% of their foreign reserves in the dollar. So 5 years ago, they held 65%. So it had already come down dramatically. And then after the Russian invasion, it started, that percentage started declining rapidly. When you're a central bank and you sell the dollars and you say, where shall I put that money? There are relatively few places you can put money. You want as I say, you want an asset that's no one else's liability. You want something that has deep liquidity. So only 2 central banks in the world have bought silver because the liquidity just isn't there. And of course the storage value is, the storage costs are much more. A couple of central banks have bought, some central banks in Asia have bought a little bit of yen or a little bit of the Australian dollar. But again, those are assets that are still someone else's liability. And so when you sell the dollar and you're a central bank, most of that goes into gold by default.
Interesting. It's interesting that you see that trend of what's happening, all these different factors that play into it, all these like little levers. And a lot of people think that, just invest in gold. Well, you also have to look at the different assets that surround it, is what you're saying.
Right.
And, it kind of tying back into that, instead of investing in one asset, you have to look at the assets all as a conglomerate.
Yeah. And let me just finish on gold. The one central thing about gold, of course, is that it is an asset that holds its purchasing power over long periods of time.
Yes.
And famously, they say a Roman centurion's outfit costs the same as a Georgian dandy's costume, which costs the same as a Brioni suit today. One you can dress a man for an ounce of gold. And that's true throughout history. No other asset has that track record like that. And the deviation is really quite astonishing, even at its worst period. Now, if you lived through it, it wasn't too good, but if even at its worst period of 20 or 30 years back in the 16th century, gold only lost 40% of its value. There's no other asset that has that long-term track record. And so when you see governments continue to issue debt, debt to GDP levels around the world, are at all-time highs in every single country, not in every country, but in many countries, not just the US. And I think gold is a way of protecting you from that. You look at the dollar. Think about the dollar. We know this, but since the Federal Reserve came in, with a mandate to ensure a stable dollar, we know this, but it's worth reminding everyone that was their mandate, a stable dollar. Since they came in 100 years ago, it's lost 99.7% of its purchasing power. So they have utterly failed. And gold is the only thing not the only thing, but gold has protected you from that.
Yeah, and I've heard that gold is a hedge against inflation. Also, it's a storage of value where you're not going to get like return on investment on like a regular investment like real estate. But if you were to take the money from real estate and put it into gold, for example, gold will appreciate and rise while the dollar's collapsing. So it will hold its purchasing power for the current day.
Absolutely. I think gold and silver gold more than silver, but gold is a long-term store of value. It's an insurance. It's a defensive investment. If you're looking to maximize your returns, then you would buy more silver. You would buy gold stocks, silver mining stocks, exploration stocks, etc., etc. That's how you maximize the returns. I mean, last year, just the index of gold mining stocks was up like 160%. The index.
Wow.
Forget about picking good ones.
Right.
And so now, of course, it's down 40% so far this year. I
right.
mentioned that. But for if you want to maximize your returns, albeit at volatility, you go for the mining stocks. If you just want a store of value as an insurance, you go for the physical.
Interesting. And I kind of want to dive in for a minute between the mining stocks versus the actual physical product. So what would be a strategy around that? Is, when you invest in either silver or gold, whatever the commodity may be, and also the mining company. So how would somebody go about strategizing that? Why would they do both or maybe one or the other?
Well, I definitely think people should do both. To me, I always say to people, you should buy physical first. Physical is like your insurance. It's like your savings account. It's like the ultimate, as I said earlier with the central banks in Turkey, for individuals, it's the ultimate source of liquidity. If you have 10 1-ounce gold coins and a bag of junk silver, you can always sell that. You can always sell that. Whatever government mandates come in, wherever you are in the world, even in Papua New Guinea, you can sell your gold. And so it's the ultimate source of liquidity. The mining stocks are an investment. It's a different objective. And I always say you should have your gold first. And is that 5% of your assets? Is it 10%? An awful lot depends on how old you are, what your income is. I always say to people always ask me, how much should I have? It's a bit like regular insurance. Well, how much insurance do you need? There's a point in your life when you get older and all your dependents have grown up and they're earning a lot of money themselves and the house is paid off, etc., etc., etc. You need much less insurance than when you're 25 or 30 or 35 and you're building a family and you've got obligations and everything else. It's just a matter of circumstances. I mean, what I do, I still do it, frankly, and I know a lot of people do. I mean, I just buy gold or silver coins whenever I feel like it. I see something that looks neat, let's buy it. But the stocks are something completely different. That's just an investment, and for us in our money management, which, by the way, we've been doing since 1991. I didn't want to make it sound like I just flipped from writing to investing We've been doing it since 1991. I mean, for us, the mining stocks are 30-40% of portfolios now. I mean, meaningful.
Wow, that's solid basis there too. And Adrian, I kind of want to dive in for a minute for the listeners out there. We've been talking about the central banks on the show quite a bit. And whether it's real estate or any investments, whatever, they have a lot of influence on investments and also these markets. How do the central banks play into whether it's gold, silver, or even the economy right now with the state of it, with, conflicts overseas and also what's happening locally, I guess, in domestic terms for the local investor? How do the central banks play in all this?
Well, no, unfortunately, they're playing a critical role because if the central banks decide to raise the borrowing level, they really can't, well, when I say they can't control, they control interest rates of the short end. They can influence interest rates of the long end by doing yield curve control and so on. But by raising rates, they make money tighter, which means it's more difficult to borrow money, which means it's more difficult to start businesses, expand businesses.
Harder to leverage.
Etc. Yeah, harder to deleverage. And often raising interest rates, as you know, is what leads to a recession.
Absolutely.
Yeah. And, the Federal Reserve, I'm not the only one who says this. I mean, the Federal Reserve is an institution that should not exist. It is, first of all, is trying to do something that is impossible. Not difficult. If something's difficult, you try hard.
Right.
If it's impossible, you're wasting your time.
Right.
And what they are doing is they are price controllers, price fixers, basically. We should not call them central banks. We should call them price fixers. And they are trying to control the price of the most important asset in the economy, namely money. And like all central planners, which is what they are, all price fixers, they will fail. There are always unintended consequences of fixing prices, and it never works. We've seen that throughout history. Go all the way back to the Roman Empire and go back to Gerald Ford and his little whip inflation, whatever it was. I mean, so pathetic, really, right?
Right.
But that's what they are. And of course, there's another criticism of the Fed, which is you have 8 people, mostly academics, who've never worked a day in their entire lives. Most of the Fed has spent their entire careers at the Federal Reserve. Never been in the real economy. Never worked a day in the private sector. But how can 8 people know not only what's going on in the economy with millions of people, but how can they know how those millions of individuals will respond to changes in money supply, changes in interest rates, changes in consumer prices? They are trying to guess what millions of individuals are going to do, and we know from Mises, we know from Hayek. Hayek was very good at this. That's an impossibility. It's what the Soviet Politburo tried to do. So as in theory, it is a bad institution, and not just worthless, but negative. And in practice, again, the dollar's lost 99% of its value since they came into being with the mandate of providing a stable dollar. They have presided over, and I would argue, well, not just me, Rothbard was very good at this as well. They have encouraged and provoked the deepest recession in U.S. history, as well as the worst inflation in U.S. history. So the track record is pretty bad.
Yep. And
but they're still trying.
Yeah, you're right. They're still trying. And we've been seeing that for years, where they're just trying and trying with zero result. In fact, negative result.
Right.
And it's simply getting worse. It's compounding in the wrong direction. Whether it comes to, capitalists or entrepreneurs, it's like, why are they still going at this? Like, aren't you tired already? Like, we've seen no return. In fact, negative return of what they've been trying to push and enforce.
And they have this idiotic 2% inflation target. Again, it's not inflation, it's CPI. But they've got a 2% CPI target. First of all, that's just nonsense. It was just picked out of the air. I don't know if you know how that came about.
I don't know, actually.
Yeah, it was the central bank governor of New Zealand, of all places, who said they really wanted to get, inflation down, and, they'd be happy if it didn't quite get to zero, but it wasn't going to get down. A reporter said, what level? And he said, well, I'm not going to say what level, we just want it down. What level, what level, what level? And in this exasperation, the central bank governor of New Zealand said, 2%. Will that make you happy? And suddenly 2% spread throughout the world as the new price stability. 2% depreciation per year is not stable. It's not price stability. And we know full well that even if you have 2%, it won't stay there. But Kevin Walsh, the new Fed chairman, to his credit, said quite bluntly that the Fed has had this target for 10 years and it has failed. It has failed to meet even that target, even its own target. It has failed to meet.
Wow, and that's deplorable. First of all, and secondly, the fact that it was just pulled out of thin air is even worse. It goes to show that it had no basis to it, or not even logistical reason to it. And we're still starting to see that negative decline. But unfortunately, we're just coming up to our time for this episode. No, not at all. I've been enjoying this. Adrian, for new investors and those that want to look at the economy for what it is right now, what is one piece of advice that you would give them today?
I think the biggest, one is difficult, but for a new investor, first of all, I would say, can I give 2?
Absolutely.
First of all, I would say start early. Start early. I can't tell you how many people have said to me, once I've got a job and once I've paid off this and once I've done that, then I'll open an account. No. Open a brokerage account right now. Nowadays you can do it with $100. You can open a brokerage with $100. There is no excuse. Start early. And why do you want to start early? Because of the power of compounding. If I may, do we have a couple of minutes or does it run out? I'll give you an extraordinary thing. Many of your older readers may know this. There was a gentleman called Dick Russell, wrote the Dow Theory newsletter, and he's deceased now, long deceased, and one of his most famous articles that he wrote was on the power of compounding, and he gave 2 investors. You had investor A, who at year 18, until he was 25 years old, so for 7 years, put $1,000 a year into a brokerage account. Then he did nothing, never added to it. Investor B didn't do anything till he was 26, till he had a little bit of money. And every year he put $1,000 into that brokerage account for the next 40 years. Do you know who ended up with more money on a 10% compounding basis? The first one. So the importance, think about that. The importance of starting early cannot be overstated. That's the first thing I say. And the second thing I would say is remember, we'll all have losses. Everybody in the investment field has losses. Losses are difficult to make up. If you lose 25%, you have to make back 30% to get back to where you were.
Yep.
Right? And you've lost, let's say you lose 25% one year and gain 30 the next year, you've also lost 2 years of gains. Losses are difficult to make up. So young people often go out on limbs, go to extraordinary, high potential investing, weird and wonderful. I say when you're younger, you should start your base. This sounds counterintuitive, but remember compounding. Start with the more conservative things when you're young, and when you've built up a bit of a portfolio, then you can afford to take some risks.
Right. You have that margin of error. And
Absolutely.
And when you have that liquidity and also that room to kind of flex a little bit, to play around with maybe stocks, crypto, Bitcoin, which I'm not too fond of, me personally, but you have that room to kind of dabble a little bit.
Absolutely. And honestly, I wish someone had given me that advice when I was young, because I was investing. It's funny, all my, if I put $1,000 into a stock, it was, if it was Nestle or HSBC or something, it was $1,000. If it was, Ajax Exploration exploring in Borneo, it was 50,000. And, needless to say, I lost a lot of 50,000s along the way. I'd be rich now if I'd followed my own advice.
Oh, that's wonderful. But you know what? I appreciate you saying that too, because it's okay to make mistakes. It's good to learn from them and to pass it on too. So I appreciate you doing that. And to my audience out there, if you want to learn more about Adrian Day and also his asset management company, please check the video description below and also the podcast description below to see what Adrian Day is up to. Please go follow him as well online. He has a lot of YouTube content and a lot of articles as well that talk about inflation, gold, silver, where the economies are heading. He's also a part with Peter Schiff as well, and a lot of people from the New Orleans Investment Conference, which I highly recommend you go to. If you want to learn more about investing, go to that conference, and please follow these gentlemen online as well. And to my audience out there, build yourself better and bigger every day. Live better, live bigger. Always move ever forward. And remember to think a little bit bigger, and also to invest smartly. And Adrian, thank you so much for coming on the show, my friend, and sharing your wisdom.
Thank you so much. And thank you, ladies and gentlemen. Thank you. Thank you.